All right, guys, welcome back to another video here. Today, we're going to be going through one of the easiest strategies or easiest, I guess, methods when it comes to smart money concept trading. So, as you can see here, today is mainly going to be about the ultimate order block trading strategy. So, first off, starting off, just going to go through some basic stuff here and just delete these off the list. So as you can see, so currently right now, I'm just showing you the line chart of the market. So we're looking at the US dollar, sorry, the US oil price market. So off already, so just without not going too much details, we can already tell the market structure is bearish. As you can see, there's a trend downwards, price is going downwards as we can see here. So off rip, these are just the basic stuff. So the trend is a downwards trend, meaning we are trading to the downside. So again, now looking at this strategy, which is the order block strategy, we are basically looking at the points where price, took a turn. For example, where price went to buy and then dropped precipitously. Went to buy, dropped. Went to buy, dropped. Obviously, this is relevant to this market because it's a bearish, is a sell, is a bearish structure, market structure. So it's obviously the trend is downwards. So that's why I'm talking about. Whereas, for example, if it was a bias, if it was a bias market, it will look like upwards, as in price will look like this. So yeah, so in this scenario example, we have a bearish market, bearish chart showing that price is going down. So now back on topic. So if we're talking about order blocks, well, guess what? So these areas that I've highlighted, first of all, what is an order block? Let's just start by saying, so order blocks are areas or price point where, the market has the last candle before price is changing direction to the downward side. So for example, if we use this area of price here, an example, as you can see, I'm just zooming a bit more. So we can see that, the market has dropped, broken its structure here, come up to retest a little bit, drop down again, come up, drop down again. So already we understand that the market is bearish. So now, obviously price pushes up, creates a, as we can see, we have a double top here. I mean, equal high. So which normally tends to means that the liquidity will come and sweep this equal high that we have here, and obviously will create a new high. However, these tend to be fake breakouts as the whole market structure is a bearish structure. So now let's go into the main reason why we're here. So order blocks. Cool. So now we know that the market structure is bearish. So this price point here, so for example, this price point here came down, was trading sideways, price went up, obviously break this swing high here, creating a new swing high, pushing back and pulling up. Now the reason why this area is very, very vital or is very, very important is because normally institutional traders or people that move the market tend to leave liquidity, or what we call, tend to leave orders above areas. For example, so let's go on the calendar and let me just show you an example here. So this is a high time frame. So this is just bearing me here. So for example, as we can see, we have this, as I said earlier, order blocks are basically the last candle, the last bullish candle before price pushed downwards to break the swing low of this trade. So as you can see here, we have identified that this candle here is the last bullish candle before price fully pushed downwards and breaking or breaking past this swing low here. So therefore we would always be interested in marking or highlighting this order block, because this was the last bullish candle that price had. I mean, the buyers were in control. This was the last candle on the daily. This is a high time frame that price had before price pushing, changing direction between the next day and the two and pushing downwards to the bottom. So now we can see that since price has pushed downwards, well, guess what that means? It means that there are some imbalances that needs to be filled on these time frames. Now, obviously, we're on the higher time frame, so things might, look a little bit, not really refined because it's quite a higher time frame. So I will go down a smaller time frame as we move along into this video. However, so yeah, so obviously we've highlighted this is the last bullish candle. So now, because we know that price is always, the market is impulse correction, impulse correction, impulse correction. That's how the market works. Buy, sell, buy, sell, buy, sell. This is what we call an efficient market or an efficient price action. Whenever we have something like this, and then price pushes up, this here is what we call an imbalance. It means it's an inefficient market. It means there are some orders that are left in this area here for price to come and liquidate all of these before we can see a continuation to the upside. So all these things tend to be how institutionals tend to, because institutional retail traders will normally, for example, this example here, okay, cool, price comes and pushes up, yet we know it's a break of structure. However, so because retail traders will put their stop loss right below this area here, and because institutional traders know that, guess what they do? Cool, so the market will go up, yeah, come that up, and then a huge drop will come because there's so much liquidity that's left in this area. There's so many imbalances that's left in this area here. Price will come down, liquidate all these orders, stop loss hunt, as we've heard that before, and then push upwards. That's how the market works. So yeah, these are all tend to be tricks and tweaks that institutional traders tend to use in order to obviously create, because before you buy, you need to, before the market, because without no sellers you can't buy. So therefore that's how the institutions make money, by activating or finding sellers in the market, i.e. retail traders with their stop losses, come and liquidate the stop loss and then enter the buyer's position to the upside. So as you can see here, for example, this is a beautiful setup here. You can see. So now I'm going to go on a lower time frame. Let's go on a 4 hour and see how price looks. So on a 4 hour, cool, we have, so some people, this is where it gets interesting in terms of the order blocks wise. So we have, let me just clear this. So we have this candle here and we have this candle here. So a lot of people are confused with which candle am I using, or because what candle am I using to use as the order block or point of reference for entering my trade, in terms of finding my entry price and stop loss. Well, normally you want to use this candle here because this is the recent candle. This is a recent candle that price had before the push downwards to break the structure here. Because even though this candle is still a an order block, we still had price consolidating around this range before fully eliminating all these obviously all this stop loss below here. So as we can see, we don't know that this green candle here is a order block. Guess what happens? Now we understand that we know price always impulse correction. Impulse correction. So again, same format. So now we know that there needs to be a correction. So let me just play it back. Now that we know that there needs to be a correction for price to push, come and touch this order block here. Well, guess what we're going to do? We're going to be waiting. So now let's see how price plays out. And just increase the speed a little bit. So cool, price, obviously trades our breaking structure here, trading towards our area of interest, our area that we're, so let me just make something clear. So whilst all of this is happening, as traders, we don't care what's happening in this area, because we know that none of this area is important to us, or it's not our point of interest or reference that we're looking for to enter trades. So whatever happens in this box or in this range here, until we are close to our area of interest, nothing is relevant to our strategy. So therefore, we ignore whatever happens in the consolidation, or whether it's an upside, or we don't, because that is another type of understanding of trading, where you need to have a deep understanding that I can make another video about in the next video or two. But right now, let's focus on the basics and the easiest straightforward strategy anyone can learn within a day or two. It's not hard. Cool. So as we can see, prices, what we call it, trading upwards towards our. So now we can see here. So now a lot of people will think, oh, the market didn't touch my area, my order block, so therefore I'm gonna what? FOMO of missing out. So a lot of people put their they'll put their selling here, and they'll put their. This is what a lot of retail traders will do, because they don't understand that all these things are all tweaks and tricks that institutional or people that control the market do in order to make money, in order to obviously liquidate all the stop losses above these areas, because they know that this area is where they know to expect to price to come, hit this point of interest, and then push downwards. That's the plan of the institution. However, in order for them to have more orders so that they can make more money, because that's how it works. The market. If someone's selling, and someone's buying, well, someone has to lose and someone has to make money, right? And it's an exchange. That's why it's called Forex, foreign exchange market. So you're exchanging your profit for a loss. So therefore, institutions have to be smart and think about, well, how can I exchange my investment so that my investment doesn't become a loss, but it becomes a profit, so that the retail trader takes the loss, whereas I take the profit. That's how it works. Simple as that. So a lot of retail traders will be like, oh, FOMO, I missed out. Well, guess what? Let me just, put my sell stop just below this candle. A lot of people will even go for a market order. But however, obviously, the little bit of smart ones will tend to put their sell stop just right below the candle, and let's see what happens. Cool. Market, yeah. So it triggers. A lot of people think, of course, I know what I'm doing. I entered rightly, and let's see how prices plays out on the order block. Cool. So we see, and this is what happens. See, because the market has the imbalance that, hasn't been fully liquidated, hasn't been fully touched before we can see a fully downwards pressure. So this is what tend to happen to a lot of retail traders, for example, because they is a FOMO of, oh, I missed out on the trade. Let me just put my sell stop right below this wick, so that obviously when prices go down, I can enter and obviously just enter the trend. Well, this all happens to a lot of traders. So this is something that you want to learn. So we just see how the market plays out. Market comes and hits our point of interest, as you can see here. Beautiful, entry right here, right on the, on the wick. This the wick low off the bullish candle, and let's just put so let's see. So normally I would put my my take profit in this area here. So there could be 3 take profits. So first of all, one of them could be let's say here, take profit 1, take profit 2, and then if you're feeling very confident, take profit 3. So let's see how the market plays this out. So let's see how prices hit our area of interest. Now let's see how prices plays out. Oh, sorry, give me a second. So okay, cool. So let's see, price hit our area of interest. Just going fast. We see, beautiful take profit 1, take profit 2 hit, and now obviously price has liquidated all the stop losses here that people have the buyers, because obviously a lot of buyers will probably think, for example, retail traders will probably think, since I've entered here and now price has changed and there's a change of direction, I wouldn't consider this order block here as an area that price could switch. Price could switch direction or change direction from buying to selling here. So all these things are very, very important that a lot of people needs to know about and understand about the market, so that you don't enter on the wrong side and end up having to regret your trade or whatever it is. So as you can see, if you put, that's a good area to take profit from. And that's a what? And so that's a what, 6, that's a 6R. So I'm risking about what, let's say 14, about 14 pips or 140 pips for 8, so 14 pips. I'm risking 14 pips to make 83 pips or 84 pips, which is amazing. So guess what? That is something that it's another way, and one of the examples that, the US dollar is currently trending high. Well, prices, but I've seen that since that, this was the last, as I can say, swing low before price went up to break structure. So this is just an example of order block. So cool, we have a break of structure. However, this is where it gets interesting, because as you can see here, price breaks, this high, close above this high, but then we start to see a consolidation and price comes down here, equal lows. So you're probably thinking, the US dollar is quite strong, it's not going to break. And this is what happens. Well, price goes up, forms a buy to sell candle, which is what we call a order block, and then break this candle here, which is a change of character, meaning there's a change of how price is moving. So therefore, if there's a change of how price is moving, well, guess what? We can also maybe find potential sells in this bullish market structure that we have here. So automatically, I will have this green candle here highlighted as an order block. So I know that since this green candle was the last buy candle before there was a push, you can see. So going back on the daily time frame, these are just little minors and breakdowns to kind of show you how, to find easy trade setups using order blocks, whether you're a swing trader or day trader. So again, because we have this, let's use the replay button. So again, we can see that price has fully broken the structure, and guess what happens? Now we're expecting price to come to our order block, our area of interest, so that we can enter a sell trade, at least to touch this area here that we have, because this can be seen an area of, demand or obviously support. So we can have a nice, reward to ratio trade. So let's see how the market plays it out. I know it's a long video, guys, I know, but I'm just trying to explain things and give an example for you to get it. So we have a beautiful touch, multiple touches on our order block here, giving us a nice entry. So let me put my, again, anyone can do this, whether a string trader or, you can put our take profit right here. So multiple take profits, you can put our take profit 1 and on this candle here, and then take profit 2 maybe somewhere here, and then take profit 3 somewhere here. Well, let's see how price plays out. So we have a beautiful, take profit 1 hit, take profit 2 hit, and nicely done. So again, this is how easy it is trading the order blocks. It's very, very easy. All you have to do is, first of all, identify the last candle that was a buy to sell before we can see a nice clean cut break of price structure, swing low here. So this is swing high, swing low, swing high, swing low. So that's literally how all you gotta understand. You have to understand what the first two things is: the market structure. What market is it? Is there a buyer's market or is it a seller's market? Secondly, where are the swing points that I need to be looking at to enter on the order block? Whether it's a daily time frame, 4 hour, 1 minute, 5 minute, it doesn't matter. As long as you identify where the swing points are, which is swing here and swing here, which is high, low. And guess what? We have a beautiful impulse. Now we wait for the correction, which you can use a Fibonacci, but obviously these are order blocks. Where the order blocks is tend to be the optimal area that price will come and trade. So again, these are easy, simple market strategies that you can use. You don't have to know too much about the market. You don't have to understand, you don't have to, obviously there's more advanced understanding of trading, and obviously there's certain things that, that you can advance level of in terms of understanding fundamentals, certain things that, that can give you an advanced knowledge of smart money concepts. But these are just the basics and simple and easy strategy that you can enter on any time frame, as long as, you follow these rules and these methods and these things that I've shown you on 2 different candles here, as we can see. So again, guys, so yeah, let me know, obviously let me know what you guys think. I like, recording videos and dropping videos and letting man learn, and anything that I can give to the best of my ability, I will do so. So yeah, again, so for you guys that are looking to trade, if you want a broker, I've got, description. I follow my socials: TikTok, TradingView, Telegram. I'm going to be active on all these socials. Get active on there. Any questions you want, ask in the comments or send me a DM. Telegram, talk to me, and obviously comment, like, share, subscribe, do all the nice things, guys. It's quite a long video, I know, but I just want to show you a video, where I break it down bit by bit for you can understand, so you can make use of these easy, straightforward strategy in any time frame, whether it's the 4-hour, 30-minute, weekly. It doesn't matter, as long as you understand these rules and principles.